Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we'll look at why sales at the sportswear company Nike are declining. Plus, we'll discuss how the Inflation Reduction Act is impacting the energy sector. But first, we begin in the M&A space. DirecTV and Dish have agreed to combine in a deal that would create the biggest pay TV provider in the U.S. That would include about 18 million subscribers. Under the terms of the transaction, DirecTV will acquire Dish TV and Sling TV from EchoStar, and DirecTV would assume about $9.75 billion of Dish's debt. The deal is contingent upon regulatory approvals and bondholders writing off nearly $1.6 billion in debt related to Dish. Co-host Alex Steele and I were joined by Geetha Ranganathan, Bloomberg Intelligence Analyst on the U.S. media space. We first asked Geetha, what's driving this deal?
What's really driving this deal is desperate times kind of call for desperate measures, Paul. So satellite TV has steadily seen an erosion of its subscriber base. I mean, at one point, it was the only other game in town, along with cable TV, for people to get access to different pay TV packages. Today, the world is a completely different place. I mean, you have cable, you have satellite, which is, of course, the traditional facilities-based operators, but then you also have a whole slew of new internet-based options, whether it's a YouTube TV, which gives you all of the linear TV options, or whether it's like completely different what are known as SVOD services, subscription video on demand services like an Amazon Prime or Netflix. And so the world today is completely different, and because of this, satellite TV has seen a huge erosion of its subscriber base. Dish and DirecTV, once upon a time, they were some of the largest pay TV operators. They have lost about 63% of their satellite subscriber base just over the past 7 years.
That's unbelievable. Did two wrongs then make a right? / will regulators like it?
So regulators, of course, squashed this deal back, about 20 years ago. But then again, it was a completely different landscape. They have to kind of understand that things have completely changed today. One of the main appealing points of satellite TV, why people even take it in the first place, is because in a lot of areas in rural America, this is the only way that you can get access to pay TV. But things have been changing because, we've had this whole initiative to narrow the digital divide. So more and more houses in rural America are getting wired up. And with that, they now have the option to switch to internet-based TV, which is, exactly what Dish and DirecTV are saying. This is the reason why they've lost subscribers. So this is the reason why there is more competition, and therefore regulators should allow the deal to pass.
And I guess a parallel announcement here is that TPG Group, the private equity company, is going to acquire AT&T's 70% stake in DirecTV that TPG doesn't already own. So in effect, a private equity owner is now going to own the entire U.S. satellite television business. What's going on there? Why is this happening?
Yeah, exactly, Paul. So it's, Charlie Ergen walking away from the pay TV business. And in many ways, again, AT&T also walking away from the pay TV business. And as you well know, AT&T had invested heavily in the media businesses. They had bought the whole Warner Brothers operation, which they kind of got rid of, selling that to Discovery. And then, of course, they had also bought the DirecTV operations, which they sold a 30% stake to TPG. They still retained a 70% stake. And of course, with that deal with TPG, they are completely exiting that business. And for both of them, if you kind of look at what, is the final end game here for both AT&T and EchoStar, or the other part of the Dish business, it's they really want to kind of focus on their core business, which is the wireless business. For AT&T, of course, it's the wireless business. For EchoStar, they have, they've amassed a huge amount of spectrum, and they ultimately want to become the fourth largest wireless player in the United States. And this deal really helps them do that and kind of focus their resources, investments, time, and energy on just that part of the operation.
This might be a dumb question, but Do they grow their customer base at this point? Is there a customer base to grow? Or as you said, do they just become better at execution and they kind of cut with synergies and that's how they become successful?
Yes, they outline about $1 billion in synergies. A lot of those will, of course, be programming costs. They still will be, with the combination, they still will be the largest pay TV operator. They will have about 19 to 20 million subscribers, but there's not a whole lot to really grow, Alex. So it's really more kind of stemming the declines, if you will, just reducing the bleeding and becoming much, much more efficient in kind of delivering customized, tailor-made packages for the pay TV market.
Yeah, Geetha, just about 30 seconds left. What's your forecast for just the overall pay TV business? Are paying subscribers going to go to zero? Are we going to be all streaming stuff soon?
I hope not, but we're definitely seeing that, YouTube TV is becoming a major player in the market. Again, they are delivering linear TV channels. They right now are, about the third or the fourth largest operator, 8 million subscribers. So they actually have more subscribers than Dish has on its satellite business.
Wow.
But we eventually, in the next 2 to 3 years, see them becoming the largest player. And then that, of course, changes the whole dynamics of the whole pay TV market, because then you have a streaming-based operator that's the largest operator of, the pay TV market.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence Media Analyst. We move now to the tech space. OpenAI is bolstering its efforts to build the world's leading generative artificial intelligence technology. The company has completed a deal to raise $6.6 billion in new funding, giving it a $157 billion valuation. The funding round was led by Thrive Capital and Microsoft. Other investors included Khosla Ventures, Fidelity Management, and NVIDIA. OpenAI also tapped global banks for a $4 billion revolving line of credit on top of its recent fundraising. For more on all this, guest host Bailey Lipschultz and I were joined by Anurag Rana, Bloomberg Intelligence technology analyst. I first asked Anurag what else he knows about what's going on with OpenAI.
Yeah, OpenAI has really taken a lead over the last 3 years because of the launch of ChatGPT. And after that, it has become the go-to things even for enterprises. We recently did a CIO survey, and OpenAI Microsoft combination was far ahead than all the other large language models that was out there. So that's on the enterprise side. And consumer side, we already know how well they are doing, both on the app that they're selling, along with the distribution that what they won with Apple being part of Siri when the software upgrade is going to come. So OpenAI in the world of large language models really at the top of the top of the mountain at this point, and this is one of the reasons you're getting these high valuations.
Yeah, I just want to put into perspective. At $157 billion, OpenAI would be larger than Uber. And at that $6.6 billion in funding relative to IPOs, it would be the 12th largest global IPO since 2018. So, Anurag, are we in a AI bubble as it relates to private markets?
I think, to be very frank with you, I can only answer that 5 years from now. But we just updated our numbers looking at capital expenditures for the top 5-6 companies. These companies, which includes Amazon, Microsoft, Meta, Oracle, etc., in 2023, they spent about $110 billion in all the things what we call capital expenditures. In 2025, they're going to spend about $200 billion. So that's a massive increase of $90 billion over a 2-year period. Where is that money going to? Expansion of data center, buying more GPUs, buying more hardware, expanding their own large language models. So it really feels real, frankly, as to the amount of money that the big guys are spending over here. And they won't be doing it if they didn't see the demand on the other side of the equation.
This has been a turbulent year for the company here. I know last November, the company's board fired and then quickly rehired the CEO, Sam Altman. Following months, they had a lot of key leaders leave, including the co-founder, the chief technology officer. It seems like the market's kind of forgotten all about that, or maybe it's not a problem anymore. How's the market dealing with some of that turmoil we've seen over the last year?
I think people tend to forget that who's really behind a lot of backing of this particular company, and that's Microsoft. And they have the biggest distribution among enterprises. So if they are basically telling people, if you want to create an enterprise application using some AI large language model, here is OpenAI model, and you can host it on our cloud platform. I think that is resonating very well with customers. So as long as that continues for the next several years, OpenAI's revenue will continue to go up. And then you can argue whether the valuations is high or not.
And just from the Bloomberg reporting, Tiger Global put in $350 million, Altimeter putting in at least $250 million. But to your point, if Microsoft is able to write such large checks, how does that impact the funding environment for AI companies? I'm just thinking about the biggest competitors for OpenAI in Anthropic and xAI.
Yeah, I mean, Anthropic is backed by Amazon Web Services at this point primarily, and almost all the others. The one thing we heard, from reporting from Bloomberg News is that OpenAI is asking them not to back up, Elon's xAI or others, and I think that's partially the reason you see all the other plays coming in because. And by the way, there's not going to be one winner. There are going to be multiple models. There are going to be multiple companies doing well here. And there is no reason Anthropic can't thrive in this way, or Mistral, or all the other large language model companies.
What do we know about OpenAI's financials, if anything?
I mean, I don't have a clear picture on it. I've read as much as you have, and we have seen projections out there for the next several years. They can get to, I don't know, 5 billion, 10 billion, or so forth. So I mean, it's unless we see the S1 when they go public, up till at that point, it's purely a guesswork.
Do we have any sense of? Do they have an appetite to go public? Is it a sense of timing? What are their plans for going public, if any?
See, my personal view is they don't need to go public at all. Yeah. They don't need the funding. They will, the whoever is part of this particular ecosystem is getting rich every day. I think they should figure out how to grab as much enterprise workloads as possible before they think about it. Because one thing is for sure, even as they are doing this land grabbing right now, they're at a loss, and they will be at a loss for several years out because the cost of running these workloads is very high, and it's going to, you're not going to see any free cash flow. You're not going to see any. But once you go public, you really go under the lens about profitability and your margins.
We only have about 30 seconds, but going back to a story that has been reported out recently in terms of giving Altman a stake in the company that could be worth more than $10 billion. What do you make of those conversations and what that could mean for the company and its ambitions?
Yeah, I mean, he's always talked about how he's doing it for the greater good of the world, but I guess when you get this much options, you change your mind on that. But it is what it is.
Our thanks to Anurag Rana, Bloomberg Intelligence Technology Analyst. Coming up, we'll break down why investors are disappointed in Tesla, despite its first quarterly sales gain this year. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move now to earnings from the sportswear company Nike. Nike reported first quarter sales that fell 10% and were short of analyst expectations. Nike also withdrew its full-year sales guidance, citing a transition to its new CEO, Elliott Hill, who will arrive later this month. The company also said it'll postpone its Investor Day, which had been scheduled for November. For more, co-host Alex Steele and I were joined by Poonam Goyal, Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence. We first asked Poonam for her take on Nike's latest quarterly results.
It was weak, right? Their sales continue to drop, and there's no signs of a recovery, at least yet, until they have a better plan in place. I'd say this year for them, their fiscal year, is going to be the year of a reset. Once the new CEO comes into play in just a few weeks, he will have a new playbook, and that playbook will drive Nike's turnaround in the fiscal 2026.
So part of that was, yes, cleaning the slate for him. They got rid of their Investor Day for all of those reasons. Can we assume that this is the trough? This is the worst it's going to get. It's only up from here?
I would say fiscal 2025 would be the year of a trough. I wouldn't necessarily say that fiscal 1Q is a trough because, as you probably heard, they have guided to fiscal 2Q sales to be down 8 to 10%, which is roughly still in line with 1Q, and with the holiday season being unpredictable, we have port strikes, we have a shorter holiday season with fewer days of shopping. Things are still very much up in the air from a macro perspective, and then Nike has its own troubles on top of that.
All right, so from your perspective, Poonam, what is the problem with Nike?
The problem is that they don't have enough newness in their pipeline, and they haven't been focused on merchandise. Nike has to have good merchandise, new merchandise, performance-based merchandise in front of consumers on a constant basis to really drive the outperformance that they had seen pre-pandemic. They lost that under the current leadership because the focus was more on DTC and using the franchises that did well and really just adding new variations of them. For example, the Air Force, right? We have so many variations of the Air Force. Same with the Dunks and same with the Jordans, just new color waves. So we need to see more. We need to see them do more on the product front and then the marketing of it, of course, too.
So what's Nike saying just about the consumer in general these days? Because I would think, boy, with their broad product line in reach, they would have a pretty good view.
The consumer is uneven. They're spending in certain places and then they're not spending. For example, they talked a lot about their new product that they brought to market earlier this year. That's actually done really well for them. And that's a good sign. But then the rest of the stuff is just status quo. They are seeing weakness in their own retail channels, and the weakness is coming from traffic, right? So this goes back to the macro a little, where traffic is down in the stores, traffic is down online, and traffic is what's hurting sales because the average selling price was actually up, which means they're able to sell these expensive sneakers. They're just not able to get enough people to come in and buy them.
Okay, do Nikes have sneakers with those heels? Because if they did, I'd feel like we'd be in a... Yeah, there's like a whole brand of like sneakers with a heel.
No.
So they're like stilettos and they have the look of a sneaker.
Oh, boy.
I don't think they have that. I think that would be helpful.
I don't think they have that, but I don't know if they actually need that to win. They probably need...
Then they're not talking to me.
I need running too.
Fair enough. But in all seriousness, though, how is China doing for Nike?
China is not doing well. China has struggled for some time. And I think the China struggle will ebb and flow. The highlight for China is the new stimulus that they have just gotten. And I think that can serve as a catalyst to help at least improve sales from where they are today in the near future, because that should get Nike back onto people's feet there as they have more spending power. The thing is, though, everyone's fighting for share in China, right? That's the growth engine for most athleisure companies. And while Nike does have a lead still in China, it's one among many players, the locals and the nationals.
30 seconds, Poonam. What's the the holiday season look like? Do we have any growth there for U.S. retailers?
There will be growth. We think e-commerce is going to lead, but we think there's a value play here. Consumers are stretched. It's a shorter season. There's going to be a lot of deals in the next few weeks with Prime Day kicking off. So shoppers will shop deals and will shop early.
Our thanks to Poonam Goyal, Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence. We look next at the EV giant Tesla. Tesla posted its first increase in quarterly vehicle sales this year, but the automaker let down investors who were expecting more of a bump from China, boosting electric car subsidies. For more, co-host Alex Steele and I were joined by Keith Naughton, Bloomberg Auto Reporter. We first asked Keith for his take on Tesla's recent numbers.
Yeah, there's a little disappointment on the vehicle sales. They came in just under analysts' expectations, about 1,000 vehicles under. They sold 462,000, and 463 was the consensus. But more to the point, they kind of missed the Whisper expectation, which was maybe as high as 470. Seems like there's some softness in the Cybertruck. There also were high expectations for sort of a cash for clunkers sort of promotion going on in China. They've doubled the incentive for EV sales if you turn in an older model there. That was expected to give more tailwind to Tesla, and that didn't quite materialize the way that investors expected.
You know, just in terms of Ubers, for example, every Uber I'm in now feels like it's a Tesla. I don't know if you guys experience the same thing. And I feel like, is that a good or bad sign for Tesla? Because, okay, it's promotional, but I feel like the reason why all the Ubers are now Teslas is because it's a promotion like, get this off my lot. Are we at the trough with that?
Yeah, Model 3 and Model Y, that is the volume of the company, which are their, mainstream cars. Their luxury Model S does not sell very well anymore. It's getting pretty long in the tooth. And Cybertruck, is priced sort of around 100,000, and that limits its volume under 20,000 probably for the quarter. So they are becoming a more mainstream brand, and when that happens, they become Ubers.
Matt from Westchester emails in here and says, is Tesla ever going to have a new model? We haven't had a new model like ever, really, like just an upgraded model.
Yeah, this is, sort of a long-standing issue that the product lineup, with the exception of Cybertruck, which for now is a niche vehicle, that the lineup is getting stale. But, Elon Musk is really focusing more on Tesla as an AI company. They have this event coming up next week to unveil the robotaxi that he's really been talking up. And that's actually moved up the stock from the way he's positioning the company. So he's trying to speak less like a traditional automaker and more like an AI tech company.
I feel like it's always been that. It's been like, Tesla's a tech company. Nope, it's a car company. Nope, now it's an AI company. How does the sales, though, that we're seeing for EVs, because that's still the bread and butter, how is that stacking up against its peers like a GM or Ford?
Well, I mean, Tesla still far and away leads the market. But GM, for example, had an excellent quarter in EV sales because they've just rolled out this $35,000 Chevy Equinox electric vehicle, and that's a great price, and it's below Tesla's lowest prices. So new competitors are coming in. Tesla is supposed to have a lower priced EV coming next year, but Elon hasn't really talked much about that. As more competitors come in, as they come in at the lower end of the market, that's going to chip away at Tesla's share.
Our thanks to Keith Naughton, Bloomberg's Auto Reporter. We move now to earnings from Carnival Cruise Line. Carnival reported third quarter sales and profits that beat analyst expectations while raising its full-year outlook for a third time this year. But the company's share slumped shortly after the report as the company delivered a softer outlook for demand next quarter. For more, co-host Alex Steele and I were joined by Brian Egger, Bloomberg Intelligence Senior Gaming and Lodging Analyst. We first asked Brian to break down Carnival's results.
Overall, strong quarter and more of what we've been seeing in the past, which is strong onboard spending. Close-in bookings look really good, and overall, the demand pace from the consumer's perspective is quite strong. I can't really attribute anything to the specifically to the stock price decline. I do know there was some discussion on the call about the effect of expense timing, higher dry dock costs, expense timing going into the fourth quarter, but that's generally in line with what was previously expected and not at all indicative of any kind of systemic cost issues. So overall, I mean, from a demand perspective, compared to the other sectors we follow, cruise lines have not shown any crack.
Yep. Where are they in terms of deploying their fleet? Are they fully deployed now? Do they keep ships in port? I don't know what they do here. How does that work?
Yeah, they're fully deployed. They're back to full pre-pandemic levels of deployment and occupancy. In fact, one of the pieces of good news going, I think, into next year is that capacity growth is quite modest. So that kind of is another favorable factor in terms of yield demand for next year.
What do we think the relationship is between, say, U.S. GDP and Carnival? Like, how recession-proof or not recession-proof or sensitive are they?
Yeah, I've generally viewed cruises in general as being modestly cyclical. But if you go back historically over decades, passenger growth has kept pace with supply growth even across weaker economic periods. Although this is broadly a consumer cyclical, it has generally proven to be less cyclical than other sectors because of the significant penetration expansion opportunity, getting more first-time cruisers.
We've heard from Carnival and from the other cruise lines that demand, as you mentioned, remains very strong. Why aren't they just launching new ships, cranking out new ships to meet the demand and try to take advantage of this?
They're doing that, and over time, you're going to see kind of this mid-single-digit capacity growth measure. It just happens to be a point in 2025 where the level of capacity growth is like 0.7%. So it's a more modest period of growth here, which I think probably entering some period of economic uncertainty, not itself a bad thing. They're also adding more amenities other than new ships, like their private island destinations and things of that sort.
Excuse me?
Very
what? Wait, so I take a cruise to a private island? Whose island?
Yeah, so Celebration Key is one of those private island destination islands that most of the cruise companies have, and that's something that they're going to be unveiling going into next year. So I think that, combined with generally strong pace of demand and the fact that on the ships themselves the onboard spending really has not let up, those are all very favorable factors. And we're obviously watching this closely given all the understandable concerns about what happens with the consumer if there's any kind of economic slowdown.
What's the biggest cost drivers that these companies have to manage here?
Yeah, I mean, generally fuel has always been something we watch carefully. Fuel, food supplies, it's kind of a different kind of labor composition than other industries. But certainly if you look at the cost growth picture, we carefully watch things like foreign currency exchange movements and fuel cost growth.
Our thanks to Brian Egger, Bloomberg Intelligence Senior Gaming and Lodging Analyst. Coming up on the program, a look at how leadership and strategy changes have impacted Harvard University financially. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Each week, we look at research from Bloomberg's NEF, previously known as New Energy Finance. They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agricultural sectors. This week, we looked at the Inflation Reduction Act and its impact on the energy sector. For more, co-host Alex Steele and I were joined by Thomas Rowlands Rees, BNEF's head of research for North America. We first asked Thomas what has happened over the last 2 years in terms of deployment and projects, and what is left to do.
I think the main thing that has happened, you'll see most of the money will have flowed through into the build out of the power sector, particularly into solar and wind and storage. Now, there's a question of whether that was all going to get built anyway. And what you would say the real value of the Inflation Reduction Act there is being more of a buffer against changing commodities prices. So when the act was passed, natural gas was pretty expensive. It's come down a whole lot since then. So at the time, you might have argued that stuff was going to get built anyway. But with the drop in prices, I think that actually maybe it wouldn't have. So it gave that stability to that sector. Then outside of that, one of the big things we've seen is the development of supply chains, where the US was really at a standing start with regards batteries and solar in particular. Now we're seeing a lot of factories being announced in different states across the country. And then finally, a real uptick in investment in hydrogen. Electrolyzer orders have significantly ticked upwards. Those are some of the it's kind of kept the power sector on the steady path that it was on, and then it's really poured fertilizer on the ground of some of these more nascent technologies.
In your world of, kind of managing this transition to a cleaner energy, what is the political risk for this market, for this part of the world, if we were to get a re-election of former President Trump? What would that mean?
It's something we get asked about a lot, and actually we're producing some research right now to really answer that question. I think one of the things that we have concluded is that actually the main provisions of the Inflation Reduction Act are probably safe for a couple of reasons. One is that in the US, it's so hard to change legislation, if you don't have a trifecta. And, whatever the result of the election, a trifecta is somewhat unlikely. And even if there was a Republican trifecta, a lot of the investment from the Inflation Reduction Act is going into states and into districts represented by Republicans. So they would have to have a really big majority in both chambers of the House. So I think there are certain aspects of the Inflation Reduction Act that could change. There's how the laws are implemented. There's a lot of regulations still being written around some of the tax credits, and that could be written differently because that happens in government agencies, which report up to the executive branch. But I think there's less risk than maybe one might assume.
How much money still needs to get deployed? I just was really struck by Sarah Week, for example. It's where all the energy people go and talk about stuff. It's a big conference, happens in Houston every year. It happens in March. And Secretary Granholm was really like, guys, come and get money. Like, we have it. We will give it to you. Come to us. Let's give us money. And some people don't like that. Some people are like, that just shows that we're spending money on stuff that we don't necessarily need to spend money on.
Yeah, I mean, it's an interesting one because for the most part, the Inflation Reduction Act is not a pot of money in that the majority of the investment would come through tax credits, which are really just dependent on how much stuff gets built. Where there is a pot of money, and I should have come in with the actual figure, is the amount that's been authorized for the Loan Programs Office. So, and that is the one that is really politically under threat because that was the program in the past that was associated with Solyndra. So there is this perception that this is money being allocated to companies that may fail. And there's a lot of that money still yet to be spent currently, and it's an ongoing process.
What industries are doing relatively well versus their benchmarks versus maybe some industries that aren't? We were talking to Brian Egger from Bloomberg Intelligence about the cruise industry and their carbon footprint and trying to manage that. Which industries are doing well and which maybe are struggling?
I suppose I think of things on a really macro level. So, I divide the world into power and transport and industry, which obviously is a real simplification. Most of the momentum in decarbonization to date in the US has been in the power sector. Okay. And most of that has been because of gas plants replacing coal plants, which doesn't get you to zero. It just brings emissions down in the near term. So wind and solar is then the next wave, and that's really starting to kick in now. So there is good progress in power. Then transport historically hasn't had great success in reducing its emissions, but I think we're just at the start of the electric vehicle wave, which is going to, I think, be a slow burn over the couple of decades, because even if electric vehicle sales increase quickly, it takes time for the whole vehicle fleet to turn over. But there is a downward trajectory in transport. So it's really industry where what we call the hard to abate sectors, where there's more work to be done.
Mm-hmm. Like cement, steel, that kind of fun stuff. Before I let you go, what I've also noticed when it comes to the IRA specifically, it really helped ignite the supply side of it with tax credits, but not the demand side. So the gap between here's my cool hydrogen thing that I just built, and then here's this company buying that cool hydrogen thing that I just built is wide.
Yes.
How do we solve that?
I mean, that's especially true for hydrogen, and that is fundamentally the issue around the policy support that hydrogen receives, is it's so much has been focused on supply. But I think it speaks to a deeper issue of what policy has to come next, because I think the nature of the Inflation Reduction Act was really throwing a lot at all these different industries to get things kick-started. It's a bit like putting petrol in the engine. Maybe not the best analogy since electric vehicles are such, but it put petrol in the engine of the energy transition in the US. Mm-hmm. But whatever comes next needs to be more like a steering wheel, because it's established this momentum, but there are all these questions now that are, we never knew we'd have this problem of, there's too much supply, where's the demand? Because at the time there was no supply and no demand.
Yeah.
So the next wave of legislation has to address that.
Our thanks to Thomas Rowlands Rees, BNEF's head of research for North America. We turn now to a Bloomberg Big Take story we focused on this week titled, Harvard Endowment Paid Out a Fortune and Lost Its Investing Edge. The story talks about how Harvard's money managers underperformed after changing personnel and strategies at the worst times. Co-host Alex Steele and I were joined by the story's author, Janet Lorin, Bloomberg higher education finance reporter. We first asked Janet to discuss her findings and what she learned.
Well, I went and read through a lot of annual reports of the Harvard Management Company, which has managed Harvard's endowment for 50 years this year. And one issue that came up, which is no surprise to our listeners and readers, is there's been a lot of turnover there since 2005. A guy by the name of Jack Mayer had extraordinary returns. The team he built, they paid their managers a lot of money for really outstanding returns. They got a lot of complaints. That system was dismantled. And since then, they've had 7 people running the fund, including some interims, but 2 people who stayed less than 2 years. Lots of turnover, lots of strategy changes, and Harvard was the envy of the world. And if you look at their 10-year return, they were in the bottom 20%.
Why the turnover? It would seem like a pretty good seat to me.
Yeah, well, there's a lot of scrutiny. And one issue is, if you're a top performer there, you're getting paid, you show up on the tax forms and everybody knows how much you are being paid. Mm-hmm. And there's a lot of scrutiny.
So what universities are doing well if we rank them in terms of return and all that?
Well, if you look at their big rival, Yale, they're in the top 10% of returns for the 10-year annualized return and the 20-year annualized return. They've had largely one person, the legendary David Swensen, who managed their fund from 1986, a Yale-trained economist until he died in 2021, and one of his trusted lieutenants has picked up where he left off. They have a very different structure. Unlike Harvard, which used to employ, more than 200 people, traders, they've always sought to work with outside managers. And they sort of were there at the beginning of private equity when there wasn't as much capital. And they, seeded a lot of these managers who've had excellent returns. And you know how private equity works. You're not going to get a big return in year 1 or year 2. There's this thing called the J curve. So it takes time. And, schools like Yale and Princeton and MIT, whose CIOs have worked for Yale in the past. They all invest together, and they've all done much better than Harvard.
So, I mean, that Yale, I call it, it's referred to as the Yale model. It used to be, back in the day, a 60-40 portfolio. Then Yale said, no, we're going to allocate a lot to alternatives. I think in the simplest form, that's kind of the Yale model. Hasn't everybody replicated that?
Well, everybody's tried to, but can you get into the funds that Yale is in? No way.
Because they're still reaping the benefits of being early.
Absolutely. But now this year and last year were not great years of returns for the biggest endowments. Private equity has really lagged in public equities. This year, what was it, 23% return? The college endowments are going to be nowhere near that. I mean, to be fully in the S&P would be too much risk for them. But, we've seen a few schools report returns, high single digits. They need to get 7-8% to get to pay their salaries plus inflation.
When we talk about what they're not investing in, there's been a huge social pushback. We see it at universities like Columbia when it comes to the war in Gaza. There's obviously been a big push against fossil fuel investments. How quick or how nimble are these endowments to respond to those?
Well, first of all, nobody is divesting from things related to Israel, but that's pretty clear. So that's not really a factor of what these colleges are doing. And Harvard did not divest from fossil fuels. They're rolling things off, and they had a loss in 2022. And they said a small portion of that was not being in the funds that, did very well in energy in 2022. Divesting is not an investing strategy. It's what does Warren Buffett say? Don't do anything with emotion. And colleges, if that's what they're looking for, you saw meddling with the change in pay structure, meddling with energy, meddling, not such a good investment policy. And Harvard has also been pretty steadfast that they're not doing anything related to the BDS movement. For 20 years, they have been.
So, they still have $50 billion endowment. They're still the biggest.
They are.
So, I'm not going to cry for these guys, are we?
No, but also, who's nipping at their toes is the University of Texas. And the reason is they have an asset that's completely uncorrelated to anything. They have oil, and they have 2.1 million acres of land in West Texas that they were just given in the 1800s by the state of Texas. And a couple years ago, they had an extra $2 billion gains that had nothing to do with anything they did investing-wise.
Our thanks to Janet Lorin, Bloomberg Higher Education Finance Reporter.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.